Hi, my name is Jim and I was retired. I'm approaching my 7th year in this unexpected retirement, and it's a DIY retirement. So I pay more attention to investments and the economy than a standard retiree might. In this video, I'm going to take up that old adage, don't fight the Fed, and suggest you don't fight the Phillies either. Before I begin, please like and subscribe to this channel. The more subscriptions, the higher it'll be in the search results. Now, in an earlier video, I explained as a retiree, I'm more concerned about runaway inflation than a recession. If I had a job, I'd be worried about a recession, and I'd be worried about keeping my job. But since I'm retired, I'm more concerned about the long-term economic future and how my investments will weather them. And inflation for a long drawn out period like the 70s is not a very good thing for anyone. So this morning's Personal Consumption Expenditures Price Index, or PCE index, came in, and it was flat with the prior month. It's not showing any signs of real decline. Noted this is the overall consumer prices rose 6.2% in September from a year earlier, same pace as August, and near the 40-year high. Now, I think the Fed missed the boat in 2021 to get a handle on inflation. They should have started raising rates then. Instead, they waited until the spring of this year to start raising rates. And a lot of people are saying that they've been raising rates very aggressively, the most aggressive since the Volcker era. Well, so's inflation. Inflation is raging, not as high as Volcker, and we haven't seen a Volcker-like rate increase either. Now, it's widely expected that the Federal Open Market Committee will raise the federal funds rate another 75 basis points in the November meeting next Wednesday. And that'll bring the upper range of the federal funds rate to 4, which sounds high, but when you consider that the inflation it's chasing is now at 6.2, it's not high enough. And if they only raise it by 50 basis points in December, as many in the market are now promoting, they'll be even shorter of missing the mark. Another old adage that you shouldn't fight the Fed, but the market seems to have a wonderful wrestling match with them. First, they were trying to figure out where the Fed was going to say inflation had peaked. Did it peak? It certainly has come down from a high earlier this year, but it still hasn't come down a lot. Now, I've been following the Fed stuff more on my Twitter feed than my YouTube channel in the last few weeks. But if you're interested in this, please go out to the Twitter feed and subscribe there. You'll get my thoughts on the breaking news rather than wait for a weekly video. And in this chart I shared on Twitter this morning, I noted the CPIU, the core CPI, and the PCE inflation read differently. There are three different readings of inflation. Core CPI, which takes out energy and food, is a good proxy for what PCE will be. And again, core CPI was 6.6. PCE turned out to be 6.2. Not exactly perfect science, but closer than the Consumer Price Index for urban workers, the top line, headline number of 8.2%. The Twitter feed presented this chart, which I've shared before. I've updated it with the latest numbers. And as I've said before, this is really a race between the blue and the green lines here. The blue is the PCE and the green is the federal funds rate. And here, back in 16, leading into 2017 and 18, the Fed funds had a tightening cycle. But they really didn't have any impact on inflation until these lines crossed here. And it was only then that they could stop hiking rates, then bring them down once they saw inflation was returning to the 2% level. Unfortunately, COVID happened. The other thing to keep in mind on this chart, again, is the latest September summary of economic projections had the median year-end Fed funds rate at 4.4. It had the latest median year-end PCE reading at 5.4. That's that yellow triangle. If we kept up with 75 basis points, we'd get to 4.75% at end of the year. And the current track the market expects through the CME Fed Watch is only 4.5%. Now, in addition to the infamous dot plot in the summary of economic projections in September, and this is what that is. This is a dot for every member of the FOMC that submits a projection. And you can see it's about a 4.4 is the median of that. In addition to this hard to read dot plot, there is a chart that shows what the median is for various variables. And again, PCE inflation, the median was 5.4, and the federal funds rate, appropriate federal funds rate, would be 4.4. That's a point away from each other. The Fed will revise this summary of economic projections in December. It'll be very interesting mid-December to see what Christmas bonus they give us for this. After trying to predict when inflation would peak, the market went on to figure out when would the Fed pivot. Now, pivot generally means that the rates start going the other direction and they start cutting rates. Well, when the Fed said that that was not likely, they began to change the definition of pivot to now it's a slowdown in the increases. And now they've pegged December as the moment it's going to, quote, pivot to a smaller increase, a 50% basis hike instead of a 75% basis hike. And again, that's not really going to do the job. The other thing they're now looking at is what's the terminal rate? Terminal rate. You know, for a retiree, that sounds dangerous, okay? But a terminal rate is the highest the rate's going to be in a hiking series. The market now predicts that that's going to be at 5%. Now, this is one of the easiest ways of looking where the market thinks the terminal rate is going to be. And this is the probabilities page of the Fed Watch tool from CME. Now, if you follow the chart here, the market is pricing in a 83% chance of a 75 basis point increase at the next meeting Wednesday. And then they're pricing in only a 50 basis point for the December 14 meeting. And then another 50 basis point in February's meeting. And you can see, doesn't increase after that. So 5% is the terminal rate that the market is now projecting for the federal funds rate. The other way to look at what the market expects is surveys. And again, Reuters came out with this survey that said that the advisors that they talked to said that the 5% was the terminal rate. You can see it here. Economists see 75 basis point hike, then downshift. Federal funds estimates of what they expect the federal funds rate to be, peaking out at that 5% in the March, May, June timeframe of next year. It was interesting to see that there's a 75% chance from this survey of economists that they talked to, 75% chance of a recession, 20% chance of a hard landing but not a recession, and only a 5% chance of a soft landing. And everybody is really concerned that the Fed is over-tightening. And again, that's part of the wrestling move. They think you're moving too fast, you're over-tightening. Again, maybe so. but we haven't seen any solid indication that inflation is falling. Paul Volcker raised the rates a lot to 20 to crush a very high inflation in the teens. We're not there yet, and I hope we never have to go that high, but we do have to get the federal funds rate above where inflation is to get it to contain it and move it back down to 2%. Now, the other thing I've seen recently is that if the Phillies win the World Series, we're going to have a recession. So here's the other economic indicator we're supposed to watch. If you don't want a recession, root against the Phillies in the World Series. Astros are favored, but I'm going to be fighting for the Phils to win for more than one reason. It's the home team, and I think it's what the economy needs right now to help contain inflation. Inflation will erode purchasing power in my retirement. A recession, short-lived hopefully, will contain inflation and allow us to get back to a good, balanced economy. I'll conclude with my standard warning. I am not an economist. I am not a financial planner. So take these as entertaining ideas from one educated consumer to another. Always do your own due diligence and seek out a professional if you need one.